This is the chart about a bullish candle and a bearish candle structure. Remember guys, this lecture is for newbies. If you want to embark on a journey of learning what forex trading is all about, if you want to understand what candle chart is or candle pattern is, all right. Now we have different kind of candle chart patterns. Sorry, we have different kind of chart patterns. We also have different kind of candle pattern too. Now basically I'm going to explain what candlestick is, because I'm trying to explain what candlestick is right now. We have basically on the chart, let me show you guys my chart. Basically on the chart we have a bar chart, which is more like this, which in this bar chart will have the open where you see this bar and the closing, right? These ones above here and below here are the wicks, right? Now we have the line too. This is line charts, which most people see on the platform which they trade, and most people use this to trade. And this is a candlestick chart, right? Now basically I'm going to explain what the kind of charts this is. Now we have a bullish candle, we have a bearish candle. Now in this bullish candle we have the body of the candle, right? As you are seeing on this picture on the screen, we have a body of the candle here, and we have the wicks. So this thing you see here are called the wicks. I will still show you guys on an actual chart. This here are called the wicks. This one is called the wicks. And then on a bullish candle, we have this rectangular square body, which is the body of the candle. But most candles on the chart doesn't close this way. Most of the times it closes in different patterns, right? So and a bullish candle, the price opens from here and closes from here, right? So, and this is the low of which this bullish candle went, and this is the high of this bullish candle, how it went, and this is the closing price, this is the opening price, right? In the sense that if there's a candle at the left hand side and the price opens, it will open from this place, maybe pull down and pull up again, then go to this area and come back and close. So the opening price and the closing price, then plus the wiki here, the wicks. This is called the wicks. These things you see here, this small line here are called the wicks, right? Then the same thing applicable to what bearish candle patterns. The price opens above and closes below, right? Now each candle varies on the time frame on which they appear. So each candle opens and closes. If it's on a 5 minutes time frame, the candle opens and closes on the 5 minutes time frame. If it is on 1 hour, it closes on 1 hour. After 1 hour, the next candle begins. At the next 1 hour, the next candle begins. If it is on weekly, after 1 week, the next candle begins. If it is a daily, after daily, the next candle begins. Let's dive into the actual chart so I can be able to explain what I've shown you on this picture. Looking at the chart, you understand that the price has been moving zigzagly up and down. And if you check the time frame we are now, we are on 1 minute time frame. So after 1 minute, after each candle closes after 1 minute, so I intentionally put this candle timer here. So after 1 minute, the candle does what? Closes. After 1 minute, the candle closes. After 1 minute, candle. If I switch the time frame to maybe 15 minutes, which means every 15 minutes each candle closes. After 15 minutes, this closes. After 15 minutes, this closes. So back to 1 minute. When you talk about the wicks and of the top and below of a bullish candle, take a look at this. When I said before that most candles doesn't close with wicks. Some close with upper wicks, some close with lower wicks. Now when you take a look at this bullish candle, let me maximize the chart. When you take a look at this bullish candle, you see this bullish candle here, this one here, this bullish candle here. So when you take a look at that, this is the open price. This is the open price of this candle. Take a look at it. See, this is the open price. Here is the open price. Then here is the low. Let me use this to explain, differentiate it. Here is the low. Here I draw my line. Here is the low of this bullish candle. Here is the open price of this bullish candle. You see that here is the open price of this bullish candle. Here, that's the open price. We'll have the closing price here, and we'll also have the high here. You see that? Also have the high, which is the wicks. So the same thing applicable. The same thing applicable with what? With the with bearish candle. So this is the high, this is the opening, this is the close, this is the upper wicks, this is the lower wicks. This is what we call a bullish candle pattern. The same thing applicable to what? The bearish candle pattern. This white here is the bearish candle pattern, and you can change your bearish candle to any color you want to change it by what? Moving towards your properties, and you can change the bearish candle to red as it is on the chart, and you can click OK. So this is the bearish candle pattern. You can adjust the kind of candle you want to have on your chart. So the bullish is blue, the bearish is red. So in this kind of candle pattern, we have explained what wicks, the body of the candle, and so on is on an actual chart. Engulfing what? Candle pattern. That is the engulfing candlestick, right? So one of the most popular, this engulfing candlestick pattern is one of the most popular formation you see in the forex chart, right? In the financial market chart, right? It is a two candle formation that appears at the top or bottom in a large market movement, right? So this small candle, the small candle followed by the big candle is what we call engulfing. But I'll still show you guys what it is on an actual chart. But you looking at that picture here, you see that we have a bearish and a bullish engulfing candle. So what it entails that the larger candle body will be larger. This larger candle body will be larger than the previous candle size, right? So taking a look at this, we have a bearish engulfing, have a bullish engulfing, and this bearish engulfing appears at the top of a market movement, right? While bullish engulfing appears at the bottom of a market movement. Now the market is on a bullish formation, which you can see this arrow here. Now when this engulfing appears, it have a small tendency or high tendency that the market is going to drop a little and pull down. The same thing applicable to bullish engulfing. If the market is coming down and we have this bullish body closes above this smaller body, we have a high tendency that the market is going to go bullish or to be bull in movement. So what entails that this big body engulfs the smaller body printed, the smaller price being printed previously. Why on the bullish is still the same thing, and this candle engulfs, like cover this small candle being printed close to it, right? So that is that about bullish engulfing and bearish engulfing. But we had to understand what's bullish and bearish. If you check the wicks and check the wicks of this candle, we take a look that this candle, it tends to like it opens on the same pace, on the same price, and this one engulfs. That is a red candle bearish, this is bullish, and this red candle engulfs the previous candle, which closes outside, which closes below this printed bullish candle, that engulfs it together, cover it up together. The same thing applicable to bullish candle, which is engulfs it together. So you see this bearish candle, that is a sell candle. Some people sell market. So you see this bearish candle and in an uptrend. So when the market is moving in an uptrend and this kind of candle prints out, you have what? A pull back. And the bullish engulfing, when this candle print out, what do you see? You see what? A sharp movement in the market. You see a sharp move, right? And we also have different kind of candle patterns, which we will still cover in the next lecture, right? So let's dive into our chart for me to show you what. Let me show you a chart for more explanation, so you won't be watching these pictures. All right. Yeah. Now this is the chart and example chart, right? So what I've explained in the previous picture, I said about engulfing. You see we have the small wick here, a small bearish candle. Remember we were talking about bullish engulfing and I have bearish engulfing. So this is a bullish engulfing. So there's a small wick, a small bearish candle closes, and the next one opens and closed above this, engulfed this candle. So we have a high tendency that the market is going to go bullish, right? Now we'll see a bearish engulfing here. See this bullish candle. Now we have a bearish candle that closes below engulfed this bullish candle, which will have a what, a high tendency that the market is going to do what, is going to what, drop. So a lot of traders uses this kind of candle pattern to trade, right? So many traders uses this kind of candle pattern in the financial markets, right? So you can be able to identify most of this candle in an actual chart. This is what a bullish engulfing, which appears at the bottom. If you want to go buy, for example, if you want to buy in the market, you may be looking out for a bullish engulfing. When you take a look at this now, this is not a engulfing candle, right? This is not a bullish engulfing because what, the market, the candle what, did not close above this, right? The same thing applicable to this one. Take a look at this. Is more like a bullish too, right? Because of what? See, look at the market what engulfed this one too. See, and still the market what continue the upward movement. If you talk about bearish engulfing, this is a good example of bearish engulfing. If you take a look at this too, you see we can call this a bearish engulfing. Take a look at this too. Some traders call this what, a bearish engulfing, because we have a bullish price, we also have a bearish price closing below this what, price. So everything you have seen, you see here, we're gonna go down to this lower side. All right, guys, we've talked about candlestick, we've talked about engulfing, and today we'll talk about the inside bar and the harami. Right now, this is a two candle formation that occurs at the top or bottom of the market move. So if you have a swing, if you have a pullback or something like that, or have a sharp move, which we'll call a fundamental move, this kind of candle helps, you know, to stabilize the sharp move or stabilize the trend. So the first candle has a candle body which follows by the second candle, which is smaller what, candle body. So in Japanese, harami means what, pregnant, right? Now the body of this second candle will be contained within the body of a what, a larger candle to the left and to be opposite what, color. So if you have a bullish candle which is blue or which is white, depending on the color you designed your candle pattern to candle chart to look like, then you're going to find these things on a sharp movement in the market. But actually I'm going to still show you guys on an actual picture chart so you understand what I'm trying to explain. So I prefer to see this entire harami candle contained inside the range of the what, of a previous candle. So this means that the higher and the low of the harami is inside of the high and the low of a previous candle. So I know this is a big English, so let me explain this to you clearly, right? And it gives this kind of harami candle or inside bar gives a powerful what, signal. All right, let's take a look. Now if you take a look at this bullish movement, so this is a bullish movement. So if anytime you want to go for a sell, a bearish movement, this appears at the top, then this appears what, at the what, bottom. So now what I've read here now, what I've explained to you here now is that, see this bullish candle, the wicks, that is the wick here. So the two are wicks, one is wick. So the wick here above and below are larger than this candle here. So assuming that this bearish move candlestick here, assuming the wicks is above this wicks here, it is not a valid harami or inside bar. So this inside bar candle, this harami candle, means that this previous what, candle is contained inside the opposite what, candle color. So that's exactly what I read here now. The body of the second candle what, will be contained within the body of the larger candle to the left or to be opposite, if it is bullish or bearish, right? So I'm going to show you this on an actual chart so you understand. So this appears, this kind of charts pattern appears on a what, on a bullish movement. So if you have a bullish movement in the market and this thing appears, we have a high tendency that the market is going to do what, come down. And we have, when the market is dropping, selling, but a bearish movement, we have a high tendency and when this appears, we have a high tendency that the market is going to go what, go bullish. So this is a bearish harami, this is a bullish what, harami. So let me go to the picture chart so you will understand what I'm trying to explain. This is a bullish what, harami, right? Remember I said bullish harami. So the bullish harami I explained here is something applied that is applicable to here. Now take a look at this. This is a bearish candle, right? This is a bearish candle stick. Now the next candlestick, the wick, did not overpass this, neither did the low of this wick overpass this. Now this bearish candle, the opening price is here, which I've explained in the first video about candlestick, right? The anatomy of the candlestick. The video is in the link below this video, or you can check it on my channel, anatomy of the candlestick. Now this is the opening price and this is the closing price. Then this is the high and this is what? The low of the what? Of this bearish candle. Now coming to this bullish candle, this is the opening price, this is the closing price, this is the high, this is the high, this is the low. High and low of what? Of this open bullish candle. Now reason why it's haram is because of even the wicks and the body of this bullish candle did not overpass this one. So this is inside of this this is inside of this bearish candle. That is why it is called harami, and that is why it's called about a bullish harami, or bullish or inside bar. Now on a bearish movement, this is clearer of what I'm trying to explain. We have a bullish, then we have this inside the bar. When you take a look at this now with your cursor in your natural chart, you see that this week also overpassed this. Assuming that this week overpassed this bullish candle, or this one overpassed this candle, we have a high tendency of what? Bullish uptrend. You may have a fake out and continue the bullish uptrend, right? So this is actual what we call about talk about a bullish harami or a bearish harami. We also call it inside bar. Now, what is the dojis? There's we have different kind of doji candles in an actual forex chart, right? An MT4 forex chart or MT5 forex chart. So there are 4 types of doji candles, all of them being one candle formation. So all of them forms in the same way, but have their differences. Yeah? So the key features of this type of doji candle is that the open and close price are the same or very close to being the same. For example, it's more like many people call it indecision candle, right? So the body of the doji will be very narrow. As the candle opens in the same place it closes. Most of the times we see all those things in the chart, but I'm going to show you that with an actual screenshotted chart example, so you can see what I mean by doji, different kind of doji. So we have four type of doji, and the difference between those doji is that the upper and the lower wicks are lengthy. So the distinction between different dojis come in the length of the upper and the lower wicks, right? So the difference between those doji candlesticks, I said we have 4 different types. It is the wicks, the upper and the lower wicks, and there is a candle called a doji, and the others are variation of that main formation, in the sense that there's a candle called doji candle, but you still have the similar ones that looks like it, which made it 4 types. We may even have more than 4 or 5 or 6 types of these doji candles, right? Okay, now let me explain the doji and the types of the doji we have. Now the main doji is the length of the upper and lower wicks will remain fairly small as the market has lost the momentum. It's lost its momentum it recently had. So if market is in a movement, let be a bullish movement or a bearish movement, and later tend to have slowed down the movement it has, we may tend to see a doji candle. So a change in direction often follows this reduction in momentum, right? I know you guys will understand what I mean by momentum, the movement, a pull movement in the market. So a doji is only a valid candle formation when it appears at the top or bottom of the market move, right? Now the second type of doji candle we have is long-legged doji candle. So the open and the close are at the same price, but the upper and the lower wicks are very long. Most of the times we see this kind of candlestick inside a chart. So this is the period of indecision. So we call it indecision candle. When you see such candle in the when you see such candle in the market, you call it indecision because you don't know the direction the market will move. You don't know if it's going to be bearish. You don't know if it's going to be what, bullish. So the period is what, indecisible. So you can't when you see such legged dodgy candle, it's indecisible. But at the top or bottom of the trend, the temptation for markets to reverse is what, very strong, as I've just said before. So the third one, we have what, gravestone dodgy. So in this gravestone dodgy with a long wick, the open and the close price of this dodgy are at the bottom of the what, candle. It is a great formation denoting the end of the uptrend, but because you can see that rarely. Maybe on a high time frame, you can see that rarely. It rarely occurs on a higher time frame. It rarely occurs on a lower time frame. But I'm still going to show you guys an example of on an actual screenshot chart, so you can understand what I'm trying to say. Understand this long English, that we are seeing on the screen. So this gravestone dodgy is also called pin bar, but we know we have a lot of pin bar. People call different kind of candle pin bar. We have some pin bar, different kind of candle names we have here. But the most important one is to pick up the important candle patterns to note what you want to do in the market. All right, the last one is a dragonfly. We know about dragonfly dodgy candle. So this is the opposite of what, the gravestone. So the gravestone has the long wiki and the candle tends to close at the bottom, but the dragonfly has its own wiki. The candle tends to close what, at the same open position at the top, at the same open what position. It's still called what, pin bar by the Western what, chart techniques. So if you make a research on these candle patterns, you understand more of it. Now let us move into the actual chart for me to explain, for you to see what I mean by what, dodgy, long-legged, gravestone, and what, dragonfly. All right, here is it, guys. So this is the original dodgy candle. This original dodgy candle. So other ones are similar to it. Now this dodgy candle is a small candle stick. You see, a small candle formation that opens above, come down again, opens below, and close in the same position, or close in a similar position where it opens. It's very small, right? And it happens either between the downtrend or uptrend. That is what we call indecision. When the market is selling, you see this dodgy candle. Whenever the market is buying, you can also see this candle formation. It can be downtrend, it can be uptrend, it can lead to up movement. It can also lead to what, down movement. Now this is the long-legged dodgy candle, which we have the long wick and long. So the market goes up, comes back again, goes down, come back again, and close either the same place it opens or does a similar spot. Maybe a few price away from where it opens. So this can also lead to bullish, or this can also lead to what, to bearish. Now we have the what, gravestone dodgy candle. So this candle appears when we have a what, a bullish trend. So on a market, when it appears what, on a bullish trend, which will certify or give you a signal for what, a downtrend, a short downtrend, not a full downtrend, a short retracement in what, in an uptrend. Now we have a dragonfly, which I've explained previously, that is the opposite of what, gravestone. Dragonfly is the opposite of gravestone. So here is the same thing. Market on a downtrend, when you get this, it will also push up. It will also trigger what, a bullish trend. So in all this candle, we have the bullish movement. We have the bullish movement here on this kind of candles. We also have what, the bearish movement in this kind of three candles. All right, let us move to the screenshot. Let us move to the next slide so you understand what I'm trying to explain. Now here is it. This is a bearish what, dodgy candle. So in this bearish dodgy, the market is in upward movement when you have a bearish dodgy, which is a blue. It all depends on your candle pattern, right? So our candle color, not pattern, guys. It all depends on your candlestick color. So if you tend to produce your candlestick as blue or white as a bullish and differentiate your red from the bearish one, it's all left for you. But here, the bullish is the blue one, and we have a bullish dodgy here, which triggers a sell movement, which we call a bearish dodgy. Don't get yourself confused here. Let me explain again. When the market is bullish moving and you have a blue dodgy candle, expect what, a bearish movement, a sharp bearish movement that will cover at least 50% threshold of this what, bullish candle. Let me not move into price action or dictation or ICT market here. Now we have the what, bearish long-legged what, dodgy. This is how the long-legged dodgy looks in an actual chart. When you check your chart, on time frame, on any time frame, you can sense this, you can see this. It appears most times, and this one too appears what most times. This one too appears most times, and this is a doji what long-legged doji, a long wick up and down. Now we have a gravestone doji. See that? As I explained here, a gravestone doji, which is more likely like this. The market goes up bullish and later drop back down and closed at the same position where it opened. Right? The same time applicable to the market sold, sell and pull back up again and closed where it started, or close to the price where it started. Now this is something applicable to the market went bullish. This is a bullish move. This is a bullish move. The market went up and came back and closed where it started, or closely where it started. Because of what? I guess this should be a fundamental trigger. Yeah, that is news trigger that's propagated this movement in the market. This is a gravestone doji. Now we have a bearish dragonfly doji. This kind of doji is when you see kind of doji, it triggers what? A sell move. This which I explained here. The market can be on downtrend, uptrend, and then you have a bullish or bearish movement. So here we have what? A bearish movement, a blue what? Dragonfly, which triggers what? A bearish movement. Why? Because here the market sold. Here market sold. Here now went back up again and closed where the price was started. It's something applicable here. The market bought, came back again and closed where it started, which triggers a what? A bearish movement. Now this is for a bearish. This is for a bearish doji in the market. Let's switch to what? A bullish doji in the market. Now here's a bullish doji. You see? So the clear explanation I did now was this doji candle. If you check the bearish one, it was blue. Then if you check the bullish one, it was what? Red. That is, the last doji candle we see here must be red for you to enter bullish. And on the bearish movement, the last doji candle you see, the last doji bullish candle you see, and an uptrend can trigger what? A bearish movement. Right? Now let us talk. This is the general doji candle we know, and this one has the types as I explained in the beginning. Now bullish long-legged doji, this is how it looks like. Right? It appears on a downtrend. Then what happens? It triggers up. Bullish gravestone, it appears like this on a downtrend. What happens? It triggers up. Bullish dragonfly, it appears like this, pull up. Next thing we have what? A bullish move. But before you have a bullish move, make sure the last candle closes above all this bullish dragon doji candle. Then you can now trigger for your entry as it goes. So that is that about this bullish doji candle. So any other thing you want to know about doji candle, you can take your time, maybe make a research. But these are the simplest way I can explain this, so you'll be able to follow in the next lecture that'll be coming up. So let me rephrase again. The doji candle, we have this normal doji we see in the market. We have long-legged doji, we have the gravestone doji, we have the dragonfly doji, and inside all these doji we have the bullish doji, we have the what? Bearish doji. So this doji occasionally appears in the market where you see this kind of thing. When you see this doji on a bullish trend, on a bullish movement, so you can trigger what? It can trigger with a bearish movement. So you can search or see this doji in a support or resistance zone, or in a demand and supply zone, or on a trend line. So if you are good in drawing trend line, which I've lectured on how to use trend line on my video, you can search my YouTube channel or check the link below this video to go to my channel and search for trend line trading. So you can see this kind of doji on a trend line. You can see this kind of doji on a support and resistance zone or mitigation areas. You can see this doji on in another block movement that came to retest or something like that, and so on and so forth. So that is that about doji. Hanging man and hammer. So even though the hanging man and the hammer looks like the same candle, right? The hammer appears at the bottom of a move and the hanging man appears at the top. This candlestick has a small body and a long lower wicks. So there will be either no upper wicks or very small ones. So as you can see here, we have only small wicks here, small ones, and we have a long lower wicks. We have a long lower wick. So the length of the lower wicks will approximately be to 2 times or more lengthy than the body, right? So this long wick like more like 2 times of this what body. So if you place this kind of body, this box here is so it's more like 2 of it. You know, it can be maybe long, but this is a hanging man, this is a man. So the color of the color of the body doesn't matter what if it is bullish what or bearish. But it has been said, you know, we have other kind of, you know, people that traders that have seen that maybe a bullish hanging man or hammer, maybe if you see a bearish hanging man below a downtrend, it triggers a sharp move, bullish or bearish. So here it has been said that the effectiveness of this formation is better if the hammer body is white, which is bullish. You see, so the hammer body is white, which is bullish, or blue, you know, a bullish hanging man, and the hanging man body is black, which is a sell. So but we're going to see this on an actual chart. Basically we can see this on a chart. When you see this on a downtrend, you know, so sometimes to be upside down, but when I get to the upside down one, it will have the name too. So we call this hanging man, we call this hammer, but it appears in between the trend. Now if you see this in a trend, in a bullish trend, it triggers what? Sell. A hanging man appears at what? At the top of a trend, while hammer appears at the bottom of a trend. We can see this and in a support zone, we can see this in a trend line zone, right? A support or resistance zone, right? So the hanging man, you can see this on resistance zone. By hammer, you can see that hammer on a what? On a support zone or demand zone. All right, let's move this to an actual chart so you can understand what I'm trying to explain. Now this is a chart. Now take a look at this now. In my previous lecture, sorry to take you guys back, you guys see this type of candles, right? See this kind of candle that I explained, gravestones and dragonfly and so many other ones, right? Now take a look at this. Is a what? Is a hammer candle. Now what happens to this place? This is a support zone. It appears on a support zone, which triggers what? A bullish what? Movement. And if you take a look at these two close to it, and this one is it's engulfed what here, and we have a what? A bullish movement. A hanging man, this looks like a way dodgy, you see, but see how this thing appears here, still have this dodgy small here, and it have a what? Up movement. Then here is a hanging man. Hanging man turns is blue too, so we tend to say that the red one, if you have a red hanging man here, that is a bearish hanging man, it's kind of strong to trigger downtrend. This is what I explained here. It says that effectiveness of this formation is better if the hammer body is white, if it is bullish, and the hanging man black is black, which is bearish. So here, if this is red, it can trigger what? Downtrend. If this same thing is blue, it can also trigger downtrend. Take a look at this one here now. You see this one? This is also what? A bearish hammer. Did you see that? But it's not that too long, right? A bearish hammer. So we have this bullish movement, right? Now take a look at this hammer too. Take a look at this one too, and have a sharp bullish what? Movement. The same thing applicable to this one too here, right? A bearish movement. This one too. A small wiki or no wiki above, but have a long wiki lower. You have a sell trigger. The same thing applies. See, if we have a red, as I explained, we have a red hanging man here. This is a red hanging man, right? This is a what? A blue hanging man, a bullish hanging man, a bearish hanging man, and it began to trigger what? Sharp downward movement. So that is that about hanging man and hammer in a forex chart. We'll talk about inverted hammer and shooting star. So even though the inverted hammer and the shooting star looks like the same kind of candle, you know, it appears at the what? At the bottom of a move on, and the shooting star appears what? At the top of a move. So the inverted hammer appears what? At the bottom of your move, which triggers uptrend, while the shooting star appears what? At the what? Top of a move, which triggers what? Bearish movement. So the time the time when this candle appears may be in a trigger of a downtrend, or maybe on a bullish movement, right? When we have a momentum in the market. So this time the upper wicks is double or more the length of the candle body, and either no or very small what? Lower wicks. So in the previous lecture, I talked about hanging man and hammer. So this is the opposite of what? That candle. We call it inverted what? Hammer or what? Or shooting star. So some people call it inverted hammer, some people call it what? Shooting star. And we still have other names being given to this kind of candle, right? So in this write-up, what I explained here now, we have a long wick. Remember, in a hammer or hanging man, we have the wicks below, and we have the candle, the price closes above, and we have a long wick, right? So this is the opposite of that candle, where we have a shooting star. This shooting star what appears what at the top, that triggers what downtrend. Now, if in most traders says that a strong shooting star will be bearish, but it doesn't matter anyway. If you can see a shooting star being bullish shooting star or bearish shooting star, it also triggers what a bearish movement, right? Then the same thing applicable to inverted hammer. We can see this inverted hammer. You can see this inverted hammer at the bottom of a trend. It can be bullish, it can be bearish inverted hammer. It can be blue, it can be red, right? It can be black, it can be white, it can be green, or it can be light green. You know, depend on the color of your candlestick, right? If market is an uptrend and this candle appears, we have a trigger of downtrend, but there's a candle that's supposed to be close to it before you can enter a downtrend. The same thing applicable to this inverted hammer, right? Now let me dive to the chart so I won't waste your time. So this is inverted hammer and shooting star, opposite of the previous lecture, which is hammer and hanging man. Now take a look at this. This is inverted hammer, which appears at the support areas, right? Now this can be red, this can be blue. In either way, it doesn't matter. So this is the bearish movement, and make sure the next candle close to it closes above this area, so you can be able to do trigger your entry. When you see this kind of trend, you don't just enter the trade, right? I'm just giving you a tips. When you see you don't just push into a trade. So wait for the next candle to close. You have dictated this is a inverted hammer. Next time that candle closes, you pick a trade. You can take your profit in the previous high or the last high, right? Now this is a shooting star. This can be blue, or this can be a red. This can be bullish shooting star, this can be a bearish shooting star. So we have a bearish shooting star, and some say that the bullish shooting star is more stronger, but either way it's all the same, right? But make sure we have the next candle closing below it, so you can also trigger a sell entry that will take you long down towards the trend. And if you take a look at this thing I explained here now, take a look at this candle here. Where is it? You see this candle? What do we call this? Give me an answer in the comment section below. So this candle now, what do we call it, and what do we call this one too? This one is still a shooting star. But here, let's take a look. Assuming that this candle appeared here now, and the candle closes above this area, we have a trigger that the market is going to go up to this area. So that is price action. So this is it about inverted hammer and shooting star candle chart or candle pattern. Today is railroad track. Right, this type of candle pattern is what we see in the forex chart, right? So this is an instance of a quick change in forex market. You can see this in a forex pairs. Any pairs in the forex chart, forex pairs, you can be able to see this kind of candle pattern. So railroad tracks are two similar lengthy candles that are longer than the average surrounding candles. So they are abnormally long, or go bullish, or abnormally bearish. So in an upward market movement, there will be a strong surge upward, and then the next candle will be almost completely undoing the initial candle, right? I want to explain this on the chart. So this will be the same in a downward trend. So this is the things we'll see in the forex chart that triggers reversal or retracement in the forex market. All right, let's take a look at this. The bearish railroad track. So when we have a bullish market, we're going to have a bullish market that is going bullish. So the last bullish candle you see here will be abnormally long, like very long candle that the whole body is being covered. Now the next candle that will do or virtually undo what that bullish candle do on a bearish movement, both candles are called railroad tracks. So we have a bullish market. They have a long bullish candle where we'll have a bull, the bull or the buyers heavy entering the market. Then the next candle appears is where the bear or the down sellers enter the market and undo what the bullish candle did. This is what we call bearish railroad tracks. Then the bullish railroad tracks when we have a downward trend, the market coming down, and the last bearish candle will be abnormally large. Then the next candle that will cover it will be abnormally bullish to cover the what? The whole candle, the whole bearish candle. So in this kind of candle pattern, they have a market that will go bullish, and we have this kind of candle which will also do what? Trigger a bearish candle. But before it triggers bearish candle, this same bearish candle will definitely have to close below this bullish candle before it triggers what? Downtrend. Because if it closes half of this candle, we may still have a little upward movement, right? So, or either if it closes below this candle, then we'll have a 50% threshold trigger before the market continues downward trend, in the sense that the market will definitely come to the half of this candle before going downtrend, right? Now, the bullish pattern too is when we have a last, when the market is dropping, selling, going down, going bearish, then we'll have a long bearish candle. Then the next candle will virtually undo what this abnormal bearish candle did, closing above. Then we'll have a bullish movement. Either we'll have a bullish movement or we'll have a 50% retracement of this candle before what? Be going bullish. All right, this is it about bearish railroad and bullish railroad track. Let's move to the actual chart so we can be able to show you what it is. All right, this is the chart of Euro JPY 15 minutes time frame. Now, if you take a look at this left hand side, we'll see that the market is downward, going down, and we have abnormal long bearish candle. Now, if you take a look at the right hand side of the candle, you see that you have also abnormal bullish candle which closes above this price, above this body price. I'm not talking about the wicks, above this body price, and we have what? A bullish movement on 15 minutes. This movement can take you up to 30 or 40 pips in 15 minutes or so, I don't know. So then the market put back to retest the 50% threshold of this candle, that is half of this candle. The market came down to retest before what? Going bullish. And this retest may be an order block or other block in a lower time frame, maybe 5 minutes or 1 hour, depending where this spike or this thing came to retest on what? On a higher time frame or lower time frame. But this railroad track triggers what? An upward movement. So this is a bullish railroad track candle formation, right? When you have a long sell candle and the other candle closes above it, then it triggers a bullish market. Then above this here is a bearish what? Railroad track, where we'll have the last candle, which is long bullish candle. Then the last bearish candle closed below the bullish candle, which triggers what? A downtrend, right? So that is that about railroad track in the forex market. We can see these opportunities in different currency pairs or different stock or different indices. Most especially it occurs on volatility indices. You can see them in the chart, and this can trigger and make you profit in the market. We're going to talk about long single wicks. Without looking for a specific candle formation in the forex market, the one thing that I pay most attention to would be the length of a candle wicks. So whatever the length of the candle body, a long single wicks will often point to a change in direction, right? This is simply explained. When there's a bull or bear market, the long single wicks that is abnormally long, which you will see in the forex chart, will definitely help to change at least 70 to 80% change in direction, either bullish or bearish. So a long wick on a single candle means that during the formation of the candle, there was an unusual aggressive battle. So the bull and the bear are battling together to know who is going to win. So there's a lot of liquidity being pumped into it. The sellers are taking charge, then the buyers enter the market aggressively, and they keep battling of who is going to win in the market, right? So whichever side was able to push charge back to actually form the we generally keep pushing. So anybody that wins in the market, either bull or bearish, will keep pushing the market at least to some pips away, 50, 100, 150 pips away before continuation of the trend, right? So an initial power surge upward by the bull is meant to retaliate by the bear. You see that the same thing vice versa. If the bear are powerful and the surge is very high, it is meant to be retaliated by by the bulls. So the bear, defending their control over the market, will continue to be aggressive for a short while afterward, right? Now, if you take a look at this upper wick here, Look at this upper wicks here. See, this is a long aggressive wick. So there's a heavy momentum in the market that is what? That is going bullish, 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 bullish. Now the bears, now the surge of bears now came into the market and keep pulling the market down. You have something like going a momentum move up and down, aggressively moving up, aggressively moving down. Now at the end of this candle, we have a small body wick which is below this which is below, which has a small body closing below. Now the next candle will open in a sell with a sell signal, or with a sell with a red bar, which will trigger what? A downtrend. And the downtrend, you can have at least 70, 80, 100 pips depending on the time frame this appears. So you can see small wicks, but the kind of wicks I'm talking about is long aggressive abnormal wicks, which you can see in the forex chart, right? Now the same thing applicable to the long wicks, right? We have a momentum of downward trend, market going bearish, 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 bearish. Now the last candle now appeared with a long sell, which that wants to turn to a railroad track candle pattern, right? Then when the candle forms a long sell, then the bear market, the bull market now enter the market, and they keep what? Aggressively fighting themselves, right? Now the bull now won the market, which will have a small body here. Remember, the body should not be a twister top body, like a small tiny body. No, we kind of have a body like this, or more like a half of it, something like that. But basically we are looking at for what? A long single wick. That is abnormal long single wicks. So when this candle closes and the bullish candle closes below it, beside it, that will trigger what? A bullish movement, which will just go a short afterward before continuation of the trend, either bullish or bearish, right? So let me switch to actual chart so you can be able to understand what I'm trying to explain. Now this is the chart, EURJPY, right? Now we have a momentum of market going bullish, bullish, bullish. Now this is the last candle, and if this candle closes above this area, we will call it a railroad, and we're going to have another abnormal bearish candle trying to undo what it does, but it didn't happen, right? Now the market went up. Now the bearish buyers, that is the bearish sellers, that's the bear market, the bear liquidities now pushed into the market. The bear sellers push into the market, people that want to sell push into the market and keep on pushing it down, and they are fighting on who is going to win and who is not going to win, right? Now the bear market aggressively won the battle on this liquidity impulse here, right? Now the next candle beside it, is bearish. So this can be able to trigger a complete downtrend. And some people trade this when we have something like this. You wait for a candle, something like this, to close below this below this bullish candle, then you can be able to take a downtrend. And some people might track this as an order block, then a break in market structure before a downtrend. And here again we have another block which triggers a pullback, retest, and continue downtrend, right? So let me not move into other block and other things, right? So this is aggressively long candle with long wicks. And this is the size of the wicks, right? So the longer than average upper wick. So the wick is very high. You can see other wicks here, but it's not bigger than this one. So we are looking out for this in the market, most especially on the higher time frame, like 1 hour. You can see this in 1 hour. At least we are sure of at least 100 or 150 pips in the market downward, right? Now take a look at the bullish This was bearish for long wick single candle wicks, right? Now this is going if you want to go bullish, right? Now we have this long one. Assuming we have another bull, we can call this a railroad, right? But no, then we have is another bear move right here, and the bullish people enter the market. So when they enter the market, what happens? They keep fighting aggressively, and the bull won. The next candle closed above it. This can trigger a bullish trend. And when you entering this trade, maybe here, right, because of this candle, maybe you enter this trade here, set your stop loss below here or here, then your take profit should be in the next swing high, either here or this other block here, which the market may tend to mitigate or tend to retest before continuation of downtrend. And if you can see now, this is weak, like call it twister top or call it twister top, yes, right? And see where this thing closes. It's not the same thing with this, right? And you can see other rejection candles here. It's not the same thing with this. So this long candle single long candle wicks is most appears in the forex market on JPY pairs and other pairs. You can be able to search for yourself. So that is that about long single wick candle pattern.
Simultaneous wicks. So this kind of wicks is the wicks that you usually see in your forex market. So a series of wicks is the heads up to the change in market direction. So when you see such thing in any market chart, in any forex chart, be it indices, be it stock, be it currency pairs, it indicates a market change in direction. So as the price keep trying to push in a direction, be it either upward or downward, it is being continually meets with resistance or support. So eventually this resistance will take over and push the market in the opposite direction. So in the market that was moving upward, like a market that is bullish, upper wicks will show pressure to the downside, right? So and in the downside market, several lower wicks will hint to the potential move upward. So let's take a look at this now. When the market is bullish going upward, the bear are putting pressure on the bullish market. Thereby, when the market tends to buy, it pulls down. When the market tends to buy, it pulls back. It can either be bullish candle, it can either be bearish candle. So we expect it to see like 3 to 4 or 5 candle rejections being upward. And those areas will be called, this kind of wicks appears in the area we call resistance, and also appears in the area we call support. So we have some rejection. Some people call it rejection pattern. Rejection candle rejects the area. So the pressure of the like here now, the pressure of the sellers are high, and here the pressure of the buyers are high. So we have a bullish movement where market tends to go up, it's moving up, and we have a rejection of this candle, and the bear now took over the market, and the market goes down, right? So these kind of things gives a momentum that the momentum of the market upward is weak, and it's like there is likely a potential move that the bear market is going to take over the market in order to drop the market downwards, right? Now the same thing applicable to this one. The market is coming downward, and we have a heavy rejection below, which means the bulls are triggering to lower the momentum of the market moving downwards, right? So when we have that rejection candle, we see most things on the support area. We call those places support areas, right? Some people call it some supply and demand areas, something like that. Then we have these rejection candles, rejection wicks. We can have it like 3, 4, 5. When you see such thing, then you have a tendency that the market is going to go bullish, and you wait for a signal for a breakout before the market, you can pick up the trade. Or if you are good in analyzing the market, you can be able to enter the trade when you see such thing in the market. So this is high tendency of change in market direction, either upward or downward. So this is wicks I'm talking about. Let's take a look at this on an actual chart. All right, now this is simultaneous wick on a real chart on a 15 minutes time frame. Okay, now take a look at this. There's a momentum of downward trend coming down. Market is coming down, and we have the last candle here. We have a rejection, rejection here, which means the bulls are trying to take in charge of the market. Now, you see these long wicks you see here are far more bigger than these ones you see here. So you have the markets went down again, the bulls came in again, the bears came in again, the bulls came. So we have like 1, 2, 3, 4, 5 wicks. Now what happened after the whole struggle and the whole everything? The market tends to go. So we have this candle that breaks out all this area. Then we can be able to enter a trade. But if you can be able to analyze this and get this kind of rejection on a higher time frame, maybe 4 hours or 1 hour, you can be able to do push into a trade. So this is a rejection spike series of long wicks being rejected on a support zone. So many people call this support zone, many people call this resistance zone. So when you see this, you call it a resistance zone, and we'll call this a support zone, right? Now, because we have this rejection, market tends to push upward, right? Now, above this area now, this is sell rejection wicks, right? Now, we have the bullish market comes up, the bear people enter the market trying to push it down, bullish people are struggling to go, it didn't work, the bearish people are pushing it down, bull are pushing it down. Then finally what happened? The bearish people killed the momentum and took the market downwards, right? So when you see such thing like this here, then your next target to should be what? Next order block here. This is the last bullish candle on a resistance area. You can draw your line here. Then we have a void here. We have something like void here. You can see that in a natural chart though. When you take a look, we have a void here. We call it smart trader or ICT. You have a void here. So you can also take a look at that. And when you see such thing, enter the trade and can place your first PTP and second TP. Even if you have another highs before, previous high before, you can measure that void or liquidity void or breaker block or other block, sorry guys, and push your take TP. So this is that about simulators wicks on a rejection area being support and resistance. So when you see this, you can be able to push in and enter a trade. You can see this in volatility indices VIX. You can also see it in forex charts in the lower time frame 15 minutes. This can be a one single spike on a high time frame in 4 hours. You see that spike on a 4 hours. We can also see that on 1 hour or daily, depending on this pair, right? So that is that about simultaneous wicks on a real chart. Monster candle, right? This is not an official candle we all see in the forex market, or candle pattern we see like engulfing, pin bar, and other things we see in the market. But it's something that over the few years I've been into financial market trading forex. I don't trade such thing, right? Most times I try to push trade and scalp it a little and leave, but I don't actually stay in the trade for a long time or have a risk to reward ratio using or trading monster candle. So a monster candle is one of the candle that would have me not to trade in it, and it makes the market undecided, right? So when you see a monster candle in the market, it's just on this market is undecided because you don't know the direction the market is going to go. Is that going to go bullish? Is that going to go is either it's going to go bearish? And after this monster candle, the market goes what? Silent. So how do you know it's a monster candle? A monster candle is one of the abnormal large candle compared to what surrounding candle. So you see the only single candle. It looks like a railroad candle, right? But it's a one big candle that is just abnormal. It's there is two half or more than what the other candles you can see in the market, in the forex charts, guys. So a lot of times a monster candle it's in its neighbor qualifies when you see it in its close candles in the chart, be it any currency pair or forex, any indices pair or stock pairs, it's abnormal, right? So a lot of times you see this setup and you just jump into it. You can either blow up your account or lose your trade or have a high risk to reward ratio. All right, take a look at this monster candle pattern here. You can see here, and whenever you see such thing in the market, avoid it. And most times it occurs on fundamental news, right? You see this on fundamental, right? A very big spike, and markets will now come to relax, and market becomes quiet. Like you won't see any sharp move again. And before that news comes in, before that fundamental comes in, what do you see? The market will always go quiet. It may range for a long time, right? When this market range for a long time, it will now become what? A massive, you can now see a massive monster candle. All right, now take a look at the left hand side here. This is a monster candle of a bearish monster candle. You see this kind of candles, little candles, little spike, and a long run you see one big bearish candle, abnormal big bearish candle, and this big bearish candle, after this very big bearish sell candle, market will become quiet. It can either go small or pull back, and when you tend to sell this candle, you be in a heavy loss because market it has a high tendency of recollecting or correcting this drastic move. That is, go for correction. Now at the right hand side you see bullish monster candle. When you have this kind of rejection, tiny candles, you see these things. We see this in the forex market, maybe during the time of NFP or during the time of PPI news or CPI news. That is fundamental news. Fundamental, that's what I can use trading. So when you see such thing, next thing you see a very sharp move that will close up, and it can happen to one monster candle, two monster candle, and at the long run, if you choose to enter, market may tend to correct that move. That's a bullish monster candle and a bearish monster candle. So let's switch to the next one on the chart so you can see exactly what I'm talking about as a monster candle. All right, that is that about a monster candle. This is an Euro USD on H4 time frame, right? So at the left hand side now, you see how quiet the market is going, bullish, bearish. bullish, bearish. Just as in literally going, forming a higher high, you know, higher high, higher low, higher high, higher low. So now take a look at the right hand side. You see a very big bullish monster candle. Now, if you choose, when you see this big bullish monster candle and you choose to enter a trade, it will ask you to, if you must set your stop loss, and the stop loss will be set below the highs. And when you set your stop loss below this area, have you seen where you enter the trade and you have a very big loss? And when you set your TP above, you tend to have your TP far away. If you want to do one-to-one risk reward ratio, see, you enter the trade here, your stop loss big stays here, which is very large, and you have to take profit at maybe 2-to-1 or 1-to-1 depending, right? So when that happens, the market goes quiet. This is why you see those sharp move, small move, and this can trigger a bullish entries will come in here. They will now come back to do what? To correct this long move. So this is what we call a bullish monster candle. On the left hand side here, sorry guys, at the right hand side here, you see a long bearish monster candle. You see, so assuming we have a long bearish monster candle and have another one bullish monster candle that helps to correct this, you can say, okay, the market is will continue uptrend, right? Maybe a full drop or retest and a continue up. But this one is single bullish bearish monster candle, which this is fundamental, and this is fundamental as it has to say, right? So the markets now keep on rejecting, become quiet. So this is 4 hours. Remember, this is 4 hours, and the market became quiet for 8 hours. 16, you see that? 12, market became quiet. Then later on, market came back to what? To correct that move before it begins to go. So after a monster candle, the market doesn't move very far. Do not trade what? The monster candle, right? It's everything here. So if you see this kind of candle, relax. Just give the market time to do whatever it has to do and give you a structure. When you have seen that this has been corrected, and if you see, look at this monster candle, you will see there's a void here. See this gap here. So market will definitely try to cover this gap, then retest before any other move, right? Now, same thing applicable to here. See this void, big FVG, fair value gap, right? You can still call it fair value gap. The market has to do what? Correct itself before the main or the market movement begins. All right, that is that about monster candle on the real life chart. Okay, and secondly, guys, when you see such candle in the market, don't trade it, except if you know how to trade fundamental. You can be able to go with direction. Go at the beginning of the direction. For example, here, if you know how to read fundamental, you can be able to enter the trade and go with the monster candle and get out of the market, or you can trail it and step out of the market. The same thing with here. If you know how to trade fundamental, you can beat the trade entry here, then hold the trade downwards and pick your profit. This is trade fundamental early, but don't enter when you see this such candle moving and you say you want to enter the trade. Is wrong. Monster candle wicks. All right, in the previous video I've talked about monster candle, right? Then this time around is monster candle wicks. So a monster candle wicks often leaves what? A long wicks behind. Is either on the support area or on the resistance area. So when this happens, the wicks will usually define as what? As a range in the market. It usually becomes a border between a support or it appears on the support area or resistance area. So market tends to range between those areas. So the market will not move beyond what? The wicks, and it becomes what we call range bound, using the end of the wicks as its outer limits. So in that sense, we'll have a support area. We'll also have a resistance area. So these wicks, these long monster wicks, will form that monster wicks, and market will hardly push over the wicks. We'll call it breakout, either on the support area or on the resistance area. So in this kind of monster candle wicks, the market will get caught, thereby making the market to range. And this range means that there isn't much room for the market to continue, right? So staying out of this kind of trade or this kind of candle or this kind of range is quite good. Quite a good idea, and you have to get yourself or relax for the market to break out on that zone before you can be able to push into a trade. So take a look at this picture below. You see that this is called a bearish monster candle wicks, right? What happens here? This is a momentum of downtrend. Market's going bearish. downwards. So now we have this monster candle and it now pulled back. The buyers now pulled back, but the bull people are not, the buyers are not much in the market. So it now forms what, a just almost like a half of the candle, if I have of the long wicks, right? So the wicks here is there now. The market will now begin to range, to bounce on this area, right? It will not break this area. To use this area as what, as a support zone. So the market will come down, bounce, and keep bouncing and keep bouncing. It can even go up again, or it can even break out, right? It can break out and retest and continue. So this is what we call a bearish monster candle wicks, right? Now on the right hand side you see what we call a bullish monster candle. So we have a bullish trend, market being bullish. So when the market is going upward, then the sellers came in, but they weren't strong, right? Now when they formed this kind of wicks, now when the market next candle begin to close, it will find it difficult to break out this area. So when they find it difficult to break out this area, market will begin to range bound on this area, to range bound, right? So it will be very difficult for market to break this area. So the market will come back and bounce, So we don't find, or we don't usually enter such trade because of that ranging pattern. That's what people call ranging in the market. So market begin to range. But when you sense this kind of big monster candle wicks, because monster candle is when it is full, but the wicks is when it's halfway and it's being leave, and it will leave a wicks behind it, right? So I will show you guys this on our natural chart so you'll be able to understand what I mean by monster candle wicks. All right, here is a natural chart of monster candle wicks. When you take a look at the left hand side of this candle, you see a long monster candle. Do you see that? Now, as this now sold, the buyers entered, right? And started going bullish. Now it didn't pull back again, it stopped here. Now when you take a look at all these candles, remember this is a daily time frame. Take a look, you don't use it daily. So even for day 1, day 2, day 3, day 4, day 5, day 6, the market begin to range and it find it difficult to break out this area. And in my farm over there, I talked about these spikes, multiple spikes, simultaneous spikes that can lead to a bullish move, right? It's in my former lecture. You can check it out. My Forex mentorship playlist is there. So you can see this market find it difficult to break out on this zone. So we call this a support zone. And when you see this on the higher time frame, 4 hours daily, you say that is a major zone where markets keep on bouncing and keep on rejecting. So here you say bearish monster candle, price remains above the low was created by the wicks. So price keep remaining here and can find it difficult to break. Now by right hand side again you see a bullish monster candle that tends to do move downward. Now price got here, rejected, pulled down. There is the sellers entered. Then what happened? Market begin to bounce because of this is a long monster candle wicks. The market find it difficult to break. We call it resistance area. So when you see such trade, it's either you don't enter the trade and wait for markets to take its relaxation, because this thing can also happen. Usually happen on fundamentals, right? What I mean by fundamentals is news. When the news comes in, like CPI, Customer Price Index, or NFP, non-farm payroll, or any kind of news you can see. You can get news link from maybe investing.com, Forex Factory, and other things, right? So this is it about monster candle wicks. It will help you when you see shorting in the market. You can be able to just relax and say, no, I don't want to pick a trade. But if you know and understand how the continuous candle usually come in, you can be able to pick a trade. But if you want to scalp this kind of thing, you can be able to do that on the lower time frame, dictating your order blocks, and know when the market tends to retest and push forward. That is that about monster candle wicks. Rejection spike, right? So in this rejection spike, I've used this kind of rejection spike in most trade, and many of you guys listening to watching this video have used this rejection spike in trading, right? So it's a full complete trading system. So it consists of level of support and resistance and a long wicked candle, right? I've talked about wicks. You guys know what wicks are about. So this rejection spike is a reversal formation and always occur at the nearby level of support and resistance area. So price will push through a recent level of support or resistance area, but fail to close past it. Many people call this rejection or fake out, fake buyers or fake sellers out. they will enter the trade and the market will go opposite direction. So this will cause a spike formation at this level, and from there the price will generally move away from that level and go back to where it was coming from. For example, we have an uptrend and the market, we may have a downtrend, markets tend to go up, and people say, yeah, it has broken a breakup block or something like that. Then people will push in, it will leave the resistance area with a spike, and market will move back to where it is going to, which is bearish movement. All right, let me show you guys. Let me talk about a rejection spike, a bearish rejection spike. Now, a bearish rejection spike will always occur when the market is moving upward to a level of resistance, right? So the price will move up and pass this level of resistance, then get pushed back down below this level of resistance, and the candle will end up closing below it. We also call it fake out or rejection. So the attempt of market to climb higher was denied by the sellers. So the sellers in the market say, no, you don't have to pass this level. We are heavier than you. So the sellers pushed into the market, and the selling pressure was more higher than the buying pressure. So the rejection spike candle can either be bullish color or bearish. So in the next example I'm going to show you guys now, I will show you what I'm talking about in an actual chart. So it can either be bullish or bearish. So let me show you guys. And take a look at this first stuff here, right? This is the resistance area, right? Now look at this. Many people will jump into this trade by going buy. It has broken this area, you buy. Now what happened next? This is a recent resistance, right? This is first resistance, and people think that the market has broken the resistance, whereas they didn't know that the candle has not yet closed. Even though the candle closed, it may just pass through it and come down. Now take a look at this now. What happened in it in SMC, that smart money concept ICT? What happened here? That the market, the price has taken out the liquidity here, right? That's taken out the liquidity inside this place and triggered a lot of stop loss here. What happened the next place? Look at it. It left a spike here. Did you see that? So it left a spike here, and what happened next? The market went down trend, like momentum was bearish. So the previous thing I just talked about bearish, like this, like bearish rejection spike. So here now, you guys have seen how this occurs on a resistance area. So the market went down. Here again, it went down. Here, it went down. So here, this is a rejection. Price refused to close above this resistance area. This is where spike matters, right? This is where resistance, when you see resistance area or supply demand areas in the chart, But this is where this matters. So you can do your back test on those areas and see this kind of action happening. Now let's talk about the bullish rejection spike. So a bullish rejection spike will occur when the market is moving downward, right? So don't confuse yourself. Bearish is when market is moving upward and trying to go down. Then bullish is when market is coming down and it the buyers will take over and it will go up. So when this bullish rejection spike is when the market is moving downward to a level of support. So the price will move down and pass the level of support and then get pushed back up above the level of support and end up closing above it, right? So the attempt of market to drop below was denied by the buyers. The buyers took over the market and say, no, you guys are not going to pass this level, right? So this is there's more buying pressure than the selling pressure. So a rejection spike candle can either be color blue or bullish or bearish. So in the example I'm going to show you guys, it's going to be bearish. Now take a look at this. A support zone, right? We have seen this in support zone. The market went up, retraced back, and did this kind of thing. You can see this kind of thing mostly on volatility indices. V75, 1000, V100, V10, 50. You can see this kind of thing. And if you don't understand this concept, many people will enter this trade. And what is happening here? The market is taking out the liquidity of this place, hitting people's stop loss because people went bullish. The market went up and they are still holding their trade. You come back and do and hit their stop loss and took out a lot of money that is stocked here. What happened? He left a spike. That is a bullish rejection spike. Left a spike and the market refused to close here. The buyers refuses the sellers to continue. And what happened next here? Boom, the market strike uptrend and moved to the original direction it was moving for, right? So this was a support, though the market came to retest the support and did this kind of thing, and the market was moving forward, so move upward. So that is that about rejection spike, the bullish rejection spike, bearish rejection spike. You can find these things on a support and resistance zones, right? You can find this rejection on support and resistance zones maybe on a high time frame, 1 hour, 4 hours. If you know what they're doing, if you get this on 4 hours, you could scale down to 15 minutes or 1 hour, and the word I can find another block there, or you can find a void, or you can find a gap there, which can make you trigger, which can trigger an entry, early entry on a lower time frame, right? So that is that about rejection spike in forex markets. Thank you guys, and God bless you. Zakatech FX signing off. Bye for now.